sense.
Got it.
And finally, a really important point. Don't invest everything all at once. Grow your portfolio gradually. Contribute a little bit regularly, maybe each month or each quarter over several years.
Dollar cost averaging.
That's the strategy. It's called dollar cost averaging. It helps you avoid trying to time the market, which is almost impossible, and allows you to potentially buy more shares when prices dip and fewer when they're high, averaging out your cost over time.
Okay, this is where, for me, it's really interesting. What if the entire market isn't always efficient? What if it's not always right about a company's true worth? How can you possibly spot those hidden gems that maybe everyone else is overlooking?
Now you're talking about the fascinating concept of value investing, famously articulated by Benjamin Graham and, of course, championed by his student Warren Buffett.
The Oracle of Omaha.
Indeed. It's all about recognizing that Mr. Market, as Graham colorfully called him, can be, well, quite irrational at times.
Mr. Market. Explain that.
Graham imagined the market as this manic, depressive business partner. Some days he's euphoric and wants to sell you his share of the business for a crazy high price. Other days he's despondent and offers it to you for pennies on the dollar. The point is, his mood, his price, often has little to do with the underlying reality of the business.
So the market price isn't always the true value.
Rarely, according to value investors. One core reason stocks can be undervalued is simply the market's poor judgment. It often fails to see or appreciate attributes that genuinely make companies money. Think about the e-commerce potential that, say, Jeff Bezos recognized early on for Amazon when others didn't.
So it's not just about what a company is now, but what the market perceives it to be or what it could be. And those don't always line up.
Precisely. Another factor. Many investors simply don't truly understand the underlying businesses of the companies they're trading. They're just trading ticker symbols. This ties into what the investor philosopher Nassim Nicholas Taleb calls the green lumber fallacy.
Green lumber fallacy.
Yeah, it's the mistaken belief that a successful trader in something, like green lumber, must be an expert in the properties of green lumber itself. Taleb found the most successful trader didn't even know green lumber meant freshly cut, not lumber painted green. His success came from understanding market patterns, not the product. It shows a disconnect.
Fascinating. So people trade without fully understanding.
Often. And another major factor causing undervaluation is short-term thinking. Most market participants are focused on the next quarter's earnings, the next news cycle. They fail to grasp a company's long-term potential or resilience.
Which brings us back to Graham's Mr. Market analogy, that